Who's going to buy all the debt? That's going to be the topic of today's video, and of course I will explain what debt I'm talking about. And I am talking about the debt that the US is in, $34 trillion of it that's never going to be repaid and essentially is worthless, although it's not, as long as the real Ponzi scheme is being propagated. But I'm more talking about the continued debt that is going to be continued to be issued just to service the debt, and the kind of snowball-esque nature of the fiat systems, which are debt-based systems, where they're at, and the continued need for the proliferation of them. Who's going to buy that? And why, as a crypto channel, am I interested in this? The reason is because if you look at the correlation, and we'll put some charts on the screen as we go through this, between assets. So this is why the rich get richer and the poor get poorer. It is a great proliferation game for your impoverishment. Most people don't understand the game that they're playing, the system, and thus are the losers of the game, essentially, and the people that understand it are the winners of it, and the people that understand it are the ones with assets that ultimately benefit from proliferation. You know, who really benefited from all the stimulus that took place in 2020? Well, it wasn't you getting your normal paycheck. Okay, yeah, you got to stay at home. It was the people that owned assets, and actually you kind of went backwards as a result of it all, but that's potentially for another video. I want to focus on all the debt that's getting released in the form of bonds and who the buyer of that is going to be and what that means for the market, and thus assets like the cryptocurrency market, which is a kind of high beta risk asset. So the debt that I'm talking about is the debt that's already out there, that needs to continuously be serviced until it's repaid. It's never going to be repaid. They're going to continue to proliferate it and roll it up. But also the debt that continues to come into existence. Even CNBC are now reporting on this. You know, all the greats are talking. You know, Ray Dalio, the coming debt crisis, great book. He's somebody that I definitely admire in regards to a market participant and actually an enabler of markets, an entire founder of markets. You wouldn't have the chicken nugget without Ray, because they couldn't fix the price of chickens, because the chicken farmers couldn't fix the price of wheat, and he did that with futures. But we're getting way off topic. So there's $34 trillion worth of debt in the United States alone. It's not as big for other countries, but it's still pretty colossal given the kind of relative size of them. And that debt is growing at an ever increasing rate, obviously because of the interest rates, and also the nature of the world that we're in, which is one where the money supply has quadrupled in the past not even 20 years, so since I think 2004. So there's a high interest rate that needs to be continuously serviced. CNBC wrote an article the other day saying that on average, they're adding $1 trillion worth of debt every 100 days. I think this is kind of lowballing it a little bit, and obviously only looking at one metric. You've got the Treasury, which is issuing this debt. Right now, they are essentially buying that debt with the money in the reserve repo, which has gone from 2.4 trillion down to, I think it's 440 trillion the last time I checked. I did a Patreon meeting yesterday. And that essentially is going to go down to zero in a very short succession of time, given just how fast things are moving. And the question is, well, who then buys that debt at a time when the Fed are expected to drop interest rates, which ultimately will lead to less of a law on that debt, and they're not stepping in and buying it, or they certainly haven't signaled that. So what that could essentially equate to, although I don't think it will because they're going to keep propagating this system, is that you could have the debt markets completely slip and devalue massively, which means that interest rates would have to go through the roof. We're on the opposite side of this, by the way. We think the Fed's going to step in, and we think they're going to inject liquidity, which is why we see downside for the dollar and why we see upside across pretty much all risk markets. We're even bullish on the bond market, which has seen huge volume at the moment. There's a bullish divergence on there, and we're also bullish on housing. Those charts are indicating to me that liquidity is coming in the form likely of the Fed, because who else is going to buy the bond? So if they didn't interject and the reserve repo ran out, and they start to bring rates down and they don't step in themselves and buy it, I don't think there's going to be a bid, because who's got that kind of money and capital at this point? And the last time we saw a slippage for the bond market was obviously with what happened with the gilts in the UK. I believe that was the first event. And then we saw the likes of Silicon Valley and all these others, you know, because you've got to remember, everybody, the system that we live in is one that you're incentivized, essentially runs on, it's a fiat system, it runs on debt. So everyone's stuff with debt, the pensions, the banks, you know, this is why the UK Gov and the UK Chancellor and the Bank of England had to step in and actually support the gilt market, because if they didn't, and they essentially said, look, we'll just buy an unlimited amount, kind of like what Japan do, and Japan is a great blueprint for everything. And if you look at the Nikkei, that's been an absolutely fantastic trade. Lots of the Japanese stocks have been amazing. Basically, as a short Nikkei, as a short yen trade, just like, you know, Warren Buffett's always hailed as being one of the best investors of all time. Well, really, he was just one of the, first of all, we're going to put a picture on the screen of him laughing with all the politicians out there who were proliferating the system and furthering it. He just understood the system and understood that you just needed to basically hedge your bets with assets against the fiat system. But if you look at what happened with the gilts, they stepped in and they said, okay, we're just going to buy an unlimited amount of them. If you look at what happened with Silicon Valley Bank, and if you look at what happened with First Republic, again, the Fed really showed a willingness to step in because they have no other choice. They have to continue to proliferate this unless they plan the demolition of it, which is why we kind of question the origins of Bitcoin and the timely nature of the cryptocurrency space coming to light, because ultimately it's very well timed. And boy, oh boy, was Satoshi if the narrative was right. Which it might be. We just tend to think, you know, there's a lot of similarities. These people are very good at creating the problem, then coming up with a reaction, or seeing what the reaction is and then coming up with a solution. So both the Bank of England, which is the UK central bank, and the Fed, which is the US central bank, have already shown a willingness to step in. If you look at the Treasury running out of money, where are they going to get that money from? That could cause the debt markets to slip. The Fed is still saying we're not going to, you know, we're still doing QT, we're still reducing the balance sheet, which they're kind of not. Go and look at the Federal Reserve balance sheet, we'll put it on the screen. At what point do interest rates become counterproductive in regards to QT? You know, they might hurt retail, but they don't hurt the banks that can just print money. And this is the whole game, you know, this is why this is why the need for a decentralized money and a monetary system is so needed, because if it's kind of like playing Monopoly against the banker, you know, you're not going to win that game, and actually, you know, eventually you're going to end up with no money, which I think is where they're going with all this. But who's going to buy the debt if they don't step in? And that's the question. And why am I seeing huge volumes on TLT? I'm bearish on yields at this point, which means I'm ultimately bearish on the dollar, which is a driver of yields, and the 2-year leads interest rates, and the 10-year yield kind of leads the dollar. I ultimately think that the Fed is going to step into the markets far sooner than people think, which gives us our dollar down story. Interest rates, of course, are probably why bonds are maybe getting a bit of a bid now, but we're seeing huge amounts of volume come in at this point where you have a bullish divergence, which has been a very good indicator for us. We're not big on the RSI in terms of small time trading, but in terms of weekly trading, it's done us very well. It's how we got into Bitcoin at 15, 16K, and we're calling it, and also doing a similar thing for the stock market. So we're also bullish on the S&P, very bullish on it. It's hit our target that we had at the start of 2023. It hit it this year. So did our NASDAQ, so did Microsoft. We have higher targets for the likes of Amazon at $263. That's not going to happen with them allowing the debt markets to crash at a time when the debt markets look good, when they've shown us they're already willing to step in. I'm talking about the US specifically here. And you have the reverse repo, which is getting drained rapidly since they upped the debt ceiling, which everyone was really worried about, but we weren't, because we said, okay, you guys don't look at the charts, which are the truth, and you've not seen the fact that the reserve repo has $2.4 trillion in it, which is very different from what happened in 2019 going into 2020, when liquidity basically dried up and they almost needed a liquidity or an excuse to pump a hell of a lot of liquidity into the system. We won't go down that rabbit hole, but who's going to buy the debt? Well, in my opinion, it's going to be the Fed. I think the markets know this. I think the insiders know this. That's why we're seeing the kind of volumes that we're seeing on TLT. And ultimately, this is going to pump assets through the roof. And even though we think David Hunter got his timing a little bit wrong, I actually think, because, you know, 2022 was definitely a bear market. There wasn't any all-time highs then. It was brutal. We managed to mitigate a lot of that. But I ultimately think his idea of this real blow-off for markets into what could be a new monetary system, what could be, who knows, a crash that the yield curve, the steepest yield curve in 40 years is potentially predicting, could be on the cards. So we're very bullish on the markets, and we think the Fed isn't that far off from stepping in, because the real question that you've got to ask yourself is, who is going to buy the debt? Do you think retail's going to be buying that debt? Maybe they do it indirectly in regards to incentivizing banks. You know, they put up emergency bank lending after obviously Silicon Valley Bank and all the others to try and stop what had previously happened happening again. So they could do it indirectly, they may do it directly, but that's going to mean essentially more proliferation and the increase in assets, which ultimately is going to divide or continue to increase the wealth divide. You know, people will blame capitalism for all of this. It's not. There's nothing capitalistic about essentially having a monopoly over money or owning money outright and having the kind of patent on it. That's not capitalist. That's more socialist, I guess, communist, I would say, probably more so. So it's very interesting. This year is going to be an extremely interesting one. Also, you've got to factor in, are they going to allow, with all of this happening and the reserve repo about to be drained, the debt markets to collapse going into an election? Now, it probably depends who wins. But I doubt that very much. And that's why I think the Fed is going to step in far soon. It's going to be interesting to see what happens when the reverse repo gets drained, because you're going to need liquidity. Where's that liquidity going to come from? Maybe they incentivize banks, maybe they incentivize pensions. You can't let the bond market fall, because the bond market is the monetary market. It is the money. Okay, whenever money comes into existence, it's done through that. It's done via debt. There's an unpayable amount of debt already, which, you know, if I lend you 100 quid and you ask for it back and say, I'm not going to pay you that, and I say, I'm not going to pay you that back, sorry, or you say you're not going to pay me that back, what's the value of that debt? Zero. It's wrote off, and that's the system. The system is a wrote off one, but people are, and they're going to keep propagating the lie, and you've got monetary or modern monetary theory and everything in here, you know, but the Fed are going to step in, I think, a lot sooner than people think, and I think what we're seeing on the charts is a precursor for that. I think we're seeing huge amounts of volume in regards to debt markets, certainly TLT, which is 20-year plus treasuries, not the yields, the actual bonds themselves. I think the yields look to be topping. I think they're going to bring interest rates down. I'm not in. The adversary of that is the bond market slips, and they have to shoot rates through the roof to incentivize people to get into there. I think that would be disastrous. I don't think that's the likely outcome. I think the adversary is, and that's the easier, the path of less resistance for them, which is just to keep proliferating and hope that nobody notices. But the reality is that, okay, everyone talks about inflation, everyone talks about the hardships and how people can't afford things, but nobody does anything about it. You know, they just kind of forget about it, just like we have the past 4 years of, you know, our lives and everything that's happened, and people don't really seem to be talking about it that much. But that's kind of all I've got for you. So this is relevant to us as crypto investors, because of course we play in a risk asset. It's correlated to the S&P, it's correlated to gold, which we're bullish on. Bitcoin is in an uptrend against both of those. We expect it to go higher. We've got targets for 150k. We'll see what forms on the way up there, see if we can get any higher with some sort of technical projections. That's not going to happen if they let the debt markets fall. Everything will fall as a result of that. It could be a case, and I will bite to this, that they allow that to happen in the short term. And that is the very reason why markets go through the roof. Because just like look at when markets started to turn, and look at when the Fed stepped in for Silicon Valley Bank. So that could be a scenario. But we'll see. We'll see what happens. We'll see if that is the catalyst for markets going parabola. They already kind of are, but they're going to go even higher. S&P's just broken out of its high. You know, it's likely going to continue to go higher. There'll be corrections along the way. But ultimately, the game is proliferation, and they can keep kicking this can down the road for as long as people don't do anything about it. You know, and people will just, maybe that's the plan. So I've often thought, and I still think, that the plan is to crash things, to level everyone off. The plan could be just to proliferate everyone to nothing, and to create this kind of like people that have and have nots, which is kind of the case already. But that's life, you know, life is like that, unfortunately. Just they've probably made it more so like that with the fiat systems. But that's really all we've got for you guys. So we think a huge amount of liquidity is coming in the form of the Fed proliferating the system even further. The adding to the balance sheet, look at the correlation between that and assets, because they're going to have to, because no one else is going to. And look at the correlation between the M2, they took away M1, and assets. The continued proliferation is benefiting asset holders, and they're going to do that I think in a big degree when they step in and have to bail out the bond market, and then they're going to kind of soothe things over. I mean, they have done a good job of getting inflation back down, to be fair, but at what cost? And that's one small part of what is a larger equation of your overall financial standing. So yeah, who's going to buy the debt? I think it's the Fed. I think as they drain the repo, that's becoming ever or more and more needed, or coming very fast, and they're going to keep proliferating. They have to, given the size of the system now, and the kind of, you know, a good way to describe it is it's literally like a snowball rolling down a hill. It will just pick up snow as it goes and gets bigger and bigger, and the mass is just, you know, gathering more and more snow as it goes down. Sorry to move the camera there. So yeah, huge amounts of liquidity coming from the crypto markets. I think this matches our kind of macro view of things, technically what we're looking at for risk assets, technically what we're now looking at, and we'll put all the charts on the screen. Hopefully they're already up there for the bond market, TLT, huge amounts of volume coming in, bullish divergence, basing out, housing's basing also, very rate sensitive market. You know, they're going to push everything up, I think, and that may be a kind of David Hunter-esque rally into a crash. We'll see, but we kind of think he's right. Just timing is everything in markets. So yeah, that's all I've got for you guys. Who's going to buy the debt? The Fed. And ultimately that's going to lead to the impoverishment of people that don't have assets, and the improvement, what's the word there? Enrichment of people that do, which is hopefully people like me and you. Thanks a lot for watching, guys. I'll see you all in the next one.